So if you're about to start trading on Betfair, one of the things that you're interested in knowing as a Betfair trader is which sport should you trade, but also you'll be interested to understand the characteristics of the market, pre-off and in play. For each individual sport, they're very different. The characteristics you see before an event starts can often be very different from the way that you would trade it when it's in play. So let's explore that in this video. If you're interested in learning to trade on Betfair, then visit the BetAngel Academy, where you have detailed, structured Betfair trading courses. And don't forget to subscribe to our YouTube channel and click on the bell icon if you want notification of new videos as they're released. So when you look at pre-off betting and in-play trading, they seem joined at the hip now. It seems like that has been all that has ever been. However, it wasn't always like that. When you go back to the traditional betting industry, you would tend to find that it was a very boring and staid place. You would go to a bookmaker, you would ask them what the odds were on a certain event, and then you would place a bet. What other options were available to you? Well, virtually none, really. You could actually go into a bookmaker, you'd have to accept the price that they want, the type of bet that they place, and you could only place a back bet. And then you're in the lap of the gods. The event would unfold in front of you, and there would be nothing that you could do about it. However, when betting exchanges came along, they created the ability to back and the ability to lay, which is the opposite of backing. But they also created in-play markets, but not the initial markets when they first went up. When you look back at the very early days of betting exchanges, in-play wasn't a thing. It didn't really exist. There were some city firms that offered spread betting on sports that were allowing you to bet on events as they unfolded. But the thought of betting on a 5 furlong race, which only lasts 1 minute for horse racing, seemed absolute madness. Why on earth would anybody bet on that in play? I mean, you wouldn't have enough time to even think about what was going on. However, it did happen. And it happened in a sort of funny way, because basically what happened was they decided at some point that they would turn events in play, and therefore people could bet on it as the action unfolded. But basically it was a sort of an experiment. They didn't sort of sit down and have a strategic thought about what they were going to do and where they were going to drive the growth in the business. They just sort of gave it a shot. And then all of a sudden the in-play liquidity started to build from there. However, problems also started to build as well, because people were exploiting information differences, the time delay between the course or the match or the event that was taking place and what was going on in the exchange. So it created quite a few problems to solve as well. Now, the in-play delay is an interesting area to examine, and it probably merits an entirely separate video, because there's all sorts of funny stories about that period when it was first invented, because it's difficult to explain without going into depth in the whole video, but there are some great stories in there, especially how people were legitimately beating the delay without using fast pitches. If you're interested in that, make sure you leave a comment and I will produce a video specifically on that. But we will park that for one moment. But yeah, it wasn't something that was consciously created. It was something that was given a shot, and then stuff started to build from there. But in the early days, it did have quite a few problems. But essentially, the in-play delay was introduced to get around some of those problems. But there are also situations where, for example, keep bets did not exist. So when we created BetAngel, we had a function called save bets. So basically, you could put a bet in pre-off, you could hit the save bets button, and then basically it would transfer to the in-play period. It took Betfair years to catch up with that and actually introduce a keep bets function. So the software side of the business was driving a lot of the development that you see on Betfair and on the bookmakers, and that has always been the case. But in the early days, there was basically no in-play markets. A few spread betting companies had done it, and the introduction of it on the exchanges was simply an experiment. They had no idea where it was going, but it seemed like it would be an interesting thing to do, and that's pretty much how in-play betting was born. Pre-off betting has been around since the very first bet was ever placed, but in-play stuff has only really come to prominence in the last 20 years. So the interesting thing about in-play betting is it has grown and grown and grown. And what you can actually see on the graph behind me is a chart. I was going to say pattern then. I'm always looking for patterns, but this is a chart of, which also forms a pattern of how the in-play betting has grown over a large number of years. And you can see that it's been a fairly spectacular growth. But part of this, there's a twofold reason for this. Part of this is because none of these opportunities existed. So as they were created, obviously that drove a fair amount of growth. But also some sports lend themselves really well to doing in-play stuff as opposed to pre-off stuff. And this, I'm talking about this from a trading perspective. From a betting perspective, in-play never existed. So when the market was created, people started betting into it. But from a trading perspective, if you look at a cricket match, for example, nothing happens pre-off. There is no activity in the market. Whereas in the horse racing market, there is a lot of activity. And also, when you look at a horse race, like a 5 furlong horse race, the market will be up for pretty much an entire day. And then the race is running, it's over within 1 minute. But if you look at a cricket match, especially a test match, it can run for multiple days. And therefore, the proportion of money that gets matched in certain sports is much higher than you tend to see on other sports. You know, different sports have very different characteristic in terms of what you would expect to see pre-off and in play. And that is fundamental to some of the growth that we see on this particular chart. Some sports lend themselves very well to that, and as those markets became popular on Betfair and people started betting and more specifically trading in play, then the volume started to rise. When you're trading in and out of a position, so the amount of money that you earn for the amount of stake that you put into the market is very small. When you place a traditional bet, you're looking to earn multiples return on that individual stake. So as a consequence, any sport where you're likely to be trading in and out repeatedly, the in-play proportion is going to be much higher because of that traded money. But as more sports have turned in-play, that's driven the growth of in-play betting overall. But that only really tells one part of the story, because you need to know how that is influenced and impacts across a range of sports. So let's have a little look at that. The easiest example to give you is horse racing. So as I mentioned at the start of this video, horse racing initially didn't have in-play markets, or they were very, very small. And it's a similar pattern of activity that you see on many markets that I've seen develop over the years. The pre-off market goes up, people are betting on that, and then the in-play liquidity sort of follows in behind that. And depending upon the nature of the sport, that's what drives that particular growth. But the interesting thing about horse racing, which I'm about to describe on the image behind me, is that when it first started, it grew fairly rapidly, the in-play betting portion of the market, but it basically plateaued at about 20%. It sort of bounces around depending upon the time of year and the type of racing that's around, because that's an influence on activity in the market, at around sort of 20 to 25%, but typically over the very, very long term, it's loitered around 20% of total market volume. And you can see on this particular graph, which goes back to when that interest really began to grow, that it grew rapidly, and then basically it sort of just plateaued and never went sort of any further from there. So the interesting thing about the way that the horse racing market works is you find that the in-play market is a direct percentage proportion of the total volume, and it has remained that way ever since. It never seems to be more than 20% of the individual market. And when you look at that, that basically means that the pre-off volume is 4/5 of the entire market on horse racing, and the in-play market is only 1/5 of that total, and that has remained static for many, many years. If the total volume in the market rises, so does the in-play. If the volume sinks, so does the in-play. The two are absolutely linked at the center of the market. I ran some stats recently to have a look at this, and exactly the same is occurring in 2020 as it did all those years ago, as you can see from this graph. It remains relatively unchanged. No part of the market is increasing or decreasing faster than the other. They're actually moving in tandem. The overall market goes up, you'll see the volumes on pre-off go up and in play, and if it declines, you'll see exactly the same in the other direction. But the most important thing is that pre-off racing is far, far, far bigger than in play. The market is open for longer, you can put larger stakes on it, and when you look at the in-play market, most of that volume is fixed and relative to the size of the market. But of course, naturally, as we get to the business end of the race, in the last sort of 30 seconds or so, that's when most of it is matched, is when people are beginning to bet heavily on who's going to win the race. But as an overall proportion, it's remained in that proportion for as long as I can remember, and it still is that proportion as we see today. So when you're looking at a sport that you would like to trade in play, there are different characteristics for each individual sport. I just showed you on the previous slide the sort of characteristics that we see in racing. 80% of volume is done pre-off and only 20% in play. But that is because when you look at a horse race, the market is up for absolutely ages and the race only takes a short amount of time. But also understand the way that people bet in horse racing. If you've got something that's 5-1 on, in other words, you're going to win £1 for every 5 that you put down, you want to see the horse and see that it's behaving before it starts the race. You want to see that it goes to post right, and then when you're happy, you'll put a bit of money onto it. But basically, if anything happens in that particular period, the price is probably going to change. You can't command a horse to run particularly well or in a certain style. You can't whisper into its ear, right, I'd like you to hold the rail. And as we get into the third furlong, I'm happy for you to move out. And, you can't talk to a horse like that. But you can, traditional footballers, cricketers, tennis players, they all have a game plan in mind that they're going to execute. And it's only when the event starts that you really begin to feel what's going on within that particular match. So take tennis, for example. You'll find that pre-off, the market doesn't do a great deal because people have already discounted via their models exactly what's going to happen. It's only when the match starts that the market begins to move to adjust to what's going on the field of play. However, if you look at horse racing, you're sort of discounting information as the race is about to begin, and then the race takes place for a relatively short period of time. Cricket, especially test match cricket, can last for days. Some of the limited over cricket is obviously a bit shorter. But again, when you look at a player warming up at a tennis match or a cricket match, you're not going to get much information in that. But if you're looking at a horse going around a parade ring, you probably will get a little bit of information. That's where the betting process really starts for people that are serious on horse racing. So different sports show different characteristics. I've listed the percentage of volume that's allocated to the in-play period on this particular slide. But you can see that if we look at cricket, the majority of money is matched in play. If you look at tennis, football and other stuff, you get this graduation of sports that go from very large amounts in play to very small amounts. That's what typically has driven that chart that I showed you previously. When you look at the growth of in play and how big it is, and you look at the growth of cricket, then obviously there's a lot of money getting matched at cricket, so the overall volume is going to go up. You'll also realise that in-play trading, without losing too much money, where the spreads are narrow and you can get in and out of the market with ease on volume, generally only occurs on the exchange. If you're sharp with a bookmaker when they're offering in-play prices, you'll probably get shut down. When you see a lot of people saying, I've been banned or restricted by a bookmaker, it's probably because you're doing something faster than they can do it, because a lot of their in-play models aren't created by supply and demand. They're taking prices from somewhere else, a model, or from their trading team. So if you exploit that, you will be restricted. However, on an exchange, you will find that you won't be restricted and that it's a free-for-all in the market and you live and die by what you do in that particular market. So exchanges actually probably find it harder to compete on pre-off markets than they do in play. On in-play, they're incredibly dominant and can't be beaten in terms of the pricing, your ability to get money on, your management of that particular trade and the liabilities and all of those other factors. But also the growth of cricket and those types of sports has really driven a lot of that in-play growth. But you have to realise that in-play is very different on one sport to another. And in terms of the overall market volume, it's radically different as well. So if you compare cricket to horse racing, you'll see there's an absolutely massive difference in terms of the amount of money that's matched pre-off versus that which is matched in play. Another thing that may guide the sort of sports that you choose to trade in play and pre-off will be determined by their seasonality. So if you look at, I trade a lot of different sports. However, if you look at all of the commentary that I give and the videos I produce and all the stuff I post on social media, you'll see that I dip in and out of markets as the year goes by. And that is because what I'm trying to do is maximize my opportunity at markets during their peak times. So on the slide that you can see behind me, we have horse racing, which you can see generally isn't that seasonal. It tails off a bit at the beginning and the end of the year, but generally there's a lot of activity on it over the course of the entire year. However, if you look at football and tennis, you'll notice that they often interchange with each other. When the football's quiet, the tennis produces a lot more volume. And when the tennis is quiet, the football produces a lot of volume. And football obviously is seasonal. And depending upon whether there's a major championship in the summer, that can introduce or subtract volume from the market. But also you notice that the tennis season completely dies away at the end of the year. There's virtually nothing on in December on tennis. So when you see me dipping in and out of sports, that's because I'm switching from one type of sport to another where the opportunity is greatest at that particular moment in time. However, I'm very unusual on that. I generally wouldn't recommend that you trade more than one sport. It's better to specialize in something, master it, and then you can start to venture out into other areas. However, I've had 20 years to do that. So typically where I see volume, I see opportunity, and where I see opportunity, I will participate in the market. So that's why you often see me dipping in and out of markets, is because of seasonality. So understanding seasonality will also allow you to identify opportunities. But more specifically, if you're trading just one sport, you've got to realize that it's better at some times of the year than it is at others. And therefore, you've got to expect your P&L to curve and follow that seasonality over time. There's no point in really going for it when there's nothing there. And when there is plenty there, then you should be expecting slightly better results. So yeah, take into account seasonality when you're trading any sport, especially the sports that are reliant upon in-play volume. So let's get into some nitty-gritty here in terms of the differences between pre-off and in-play. And I'm going to start with an example on horse racing. So when you're actively trading a horse racing market, what you will find is that pre-off, the market tends to work within a narrow band. Now I say tend, I'm really generalizing. I can't stress to you how much I'm generalizing here, but I'm trying to get across a concept to you, which is why I'm generalizing. But typically the market will work in a band. When you are looking at the market, that band could be narrow or it could be large or it could be tilted in one direction or the other. But for the sake of what I'm talking to you about here, I've just expressed it very simply as a narrow band. But it will work within a band, and that band we call the traded range. So if you're trading pre-off, the maximum amount of money that you can make is the extent of that trading range. But the way that you should look at this is flip it on its head in the other direction, because the maximum loss that you can make is also this traded range. If you're deeply unlucky and you're presenting no skill to the market whatsoever, then your maximum loss will be backing at the top of the range and laying at the bottom. However, if you are skillful, then your maximum profit will be laying at the bottom and backing at the top. And therefore, you should find that your returns when you're doing pre-off trading will be relatively small, but also your losses will be relatively small as well. And I prefer to lurk in the pre-off market simply because there's significantly more volume. And despite the fact that those returns will be smaller, they're reasonably equally distributed. So the sort of game that you're playing when you're trading pre-off racing is you're just saying that you know where the price is going to go or not go. You're basically saying, I've got a fair idea of where I can get my orders matched within the next 30 seconds. And you're basically taking a very small amount of risk because your maximum loss is capped by that range effectively. But also your maximum gain is capped by that range. So you have to be appreciative that basically the returns are going to be equally distributed in both directions. Your role is to tip the market slightly in your direction by being a good trader, but that in fact you should expect small losses and small profits. And you're just trying to tip that in your favor overall. But typically that's how you would look at and approach pre-off trading on horse racing. So the general characteristics that you have with pre-off trading is that it will be in a narrow range. By narrow, we mean a clearly defined plus or downside. And that isn't extreme. It's always going to be a relatively small amount. The majority of the time that you're active on a horse racing market will be in the pre-off period. The in-play period is a narrow slither of the amount of time that the market is available. But it's also result independent, meaning that whatever happens pre-off, it's driven purely by opinion. There's no sort of anything tied to the final result. It's just a pure opinion as to whether you think this horse is going to shorten in price, expand. The only time that doesn't happen is if the horse bolts off into the distance, because typically if it runs off into the countryside without its jockey, its chances are going to be decreasing that it has saved enough energy for the remainder of the race. But outside of that, it's purely an opinion-driven based market. Now, when you're looking at an in-play market, we are looking at something completely different. All of a sudden, we switch from this opinion-based, narrow traded range into a market that is driven purely by fundamentals. You're in the market for a minority of the time that it's actively traded. It becomes results dependent. If the horse is 5 lengths ahead instead of 1 length or 2 lengths behind, you're going to get very different pricing. So by Result dependent, what we mean is it's going to derive a big chunk of its price from the action that's taking place on course. If somebody can see that in front of you or has a slightly better opinion than you, then they will do better than you. But when you look at the final result that you get with InPlay, you can take it to its extremities. If you back the favourite and it wins, well, hey, you're going to get a winning bet. But also, if you think about it from a trading perspective, your winning trade could be any number of points between the price that it went off at the start of the race and its winning price. So you also have to look at it slightly differently, because you're sort of saying a lot of the time in play, you're sort of saying, well, how much is the price going to move before it goes in the direction and before the result becomes apparent as to how the horse is going to win. So, you could find that the horse gets off to a good start, but then fades dramatically and the price goes out. Or you could find that the horse is held up at the rear, gets off to a bad start and storms through to win it at the end. So, you're going to be playing a couple of different things here. Is the horse going to win? How's it going to perform as the race gets underway? And as a consequence, anything that you do in play is going to have an absolutely massive traded range compared to pre-off. But also it's going to be very dependent upon how the way that the race is run. It sounds obvious, but if you think about it, this radically changes the way that you would typically approach a race. But if you look at the difference between the two, this sort of shows you that it's very difficult to mix the two strategies together, because you've got a very narrow traded range pre-off and then you've got a massive one in play. It's going to be absolutely huge. So if on pre-off you're saying this is my gain, this is my loss, and if you say pre-off this is my gain, in play your loss is going to be potentially massive. So one of the biggest mistakes that people make when they're starting to trade is they take a trade that should look like this and they introduce a loss that could potentially be much larger, which makes it very difficult to do. So this is why you often see people recommend that you trade either pre-off or in play, but you don't mix the two. There are some strategies that dovetail the two to some extent, but the sort of metrics that you use on those is very different from the way that you look at it pre-off or in play. You have to construct strategies that have a tolerable level of risk and a tolerable level of payoff in order to be profitable in the long term. But yeah, the in-play market, radically different from the pre-off market. So if you look at the slide that's behind me, it helps if we try and encapsulate your opportunity in play by looking at it in a different way. So what I've done here is I've produced a chart. It's a Betfair chart, and I've just stripped out all of the detail, which it's the implied chance chart, or the implied probability of this horse going on to win this race. And I've done it from 0 to 100%. And you can see there's a big red area and there's a big blue area. And because we've backed or laid this horse at odds of 2, we're converting that 2 into a percentage, which says that it has a 50% chance of winning or losing. And that's why I picked 2, because it would make for a very easy chart to display to you. But basically, if we place a bet on this race, there's a 50% chance that it will win, and there's a 50% chance that it will lose. Because after we place that bet pre-off, the in-play action will take place, and then we will find out at the end of the race if it's won. And over the long term, we would expect that to sort of balance out. So let's turn that bet into a trade. And you can see I've put a green slither inside the lower half of this particular graph. So we're saying that we're going to lay this particular horse at odds of 2, and we're going to trade out slightly above that in play. What I've done here is I've given us about a 5% margin, effectively, of opportunity. So what you'll see here is that actually that slither is a tiny part of the potential for this horse to actually go on and profit for us, because that big blue area is what will happen if this horse doesn't win that race, and we're only taking a tiny little cut of that. And as a consequence, that's going to occur quite frequently. So say the horse gets off to a bad start, our order will get matched immediately. Let's say the horse gets off to an okay start and is held mid-division, but it hasn't got the rails and isn't near the front. Then that price will probably drift to reflect that. Or let's say that the horse is on the rails, gets into the lead, but begins to tire out. It will get matched then. There are many, many scenarios where this situation will get matched. But however, if we look at this from a different perspective, let us imagine that this horse gets off to a great start, hoses up, and wins. All of a sudden, that red area is our potential loss, and you can see that we've only got a tiny slither of profit. So if we put that tiny slither of profit into the loss area and replicate it upwards, you can see that basically, if we're going for a 5% gain on a race where the horse has got a 50% chance of losing, we're going to have to get that trade many, many times in a row to be able to make a profit long term. Because if we only get 1 or 2 losses in a sequence of events, and we've got to get a lot of those greens to stack that bar up to be able to reach that particular higher level to overcome that particular loss. So when you're looking at trading in play, this is the thing that you need to be worried about. It's not the profits, because they're relatively easy to come by. If we look at that thin bar and put it into the profit area, into the blue area, you can see that in fact that could happen very frequently in a number of different types of ways. However, when the loss comes, we have to make sure that we've won enough races for that green area to completely cover over all of that potential loss. So yeah, you've got to reshape the way that you look at a particular race to understand how you're going to profit in play. The risk level that you're taking isn't like the pre-off, where we've got a narrow traded range and we're going to work within that traded range. Our maximum loss is that traded range. When you do in play, your maximum loss may be many times the potential gain that you're putting into the market using any particular trading strategy. So it's important that you're very aware of that. So to sort of reiterate and make the point on in-play trading a little bit more succinct, then you should have a look at the image behind me, because what this is actually showing you is the chance of an order getting filled in play. So in line with the two slides, which I hope you've sort of understood that I just put before this, what we're saying is if you use a small potential trade value, like a 5-tick gain, the chance on that getting matched is very, very high. So on this particular chart, at the bottom, we've got the number of ticks that you're offsetting in play when you're doing a lay to back. And then you can see on the y-axis, we've actually got the percentage chance of that getting matched in play. So if you do a small number of ticks, you will get matched very, very frequently. And as you increase the number of ticks, what you'll find is that basically gradually declines over time. So 5 ticks, 10, 15, 20, 25, and basically it declines away into non-existence eventually. So you'll win very frequently if, say, for example, you do a 5-tick offset, but you're not particularly worried about that because your liability will be many, many times your potential stake if you're doing a lay to back. So as a consequence, you only need a small number of those to fail in order for the potential loss to overturn any profit that you'll make on a large number of races. So yeah, you need to be a little bit more creative. Like I said, everybody loves to win, but it's winning in the long term that's more important to you. Anybody can produce a series of winning trades if they're doing a high strike rate strategy, but you're not particularly concerned with that. You've got to bring a little bit more skill to the mix when you're actively trading in play. And you also need to pick points in the market where that risk and reward is a little bit more balanced. Take my advice here in that most of the best places to be in the market are the most least obvious ones, and that typically relies upon being in places that don't win very often because most people tend to ignore it and they go for the low-hanging fruit. But unfortunately, everybody's doing that, so there's no value in getting involved in the market at that particular point. But anyhow, pause the video if necessary, have a quick look at this graph, try and understand it, but it's plotting the number of ticks that you offset from the starting price and how frequently it will get matched in play. But this is the base level at which the market achieves this. So your role as a trader, your mission, should you choose to accept it, is to exceed that base rate. That's the only way that you'll make money in the long term. So I've talked a fair bit about racing, but we need to talk about other sports as well. I could go on forever. In fact, I've got so many examples. I was going to do tennis and I thought, well, no, that's going to be so complicated to explain. But if we look at football, let me give you an example about trading in play at football. If you back a team to win a football match, then you're playing a value game. You have to exceed those odds somewhere or another or reduce your losses in order to be able to win money in the long term. But if you're trading in play on football, you're taking a position to trade out in play at some particular point. And I can illustrate a point to you here about where people go wrong when they attempt to do that. And as I just mentioned, sometimes the most obvious places to be are the ones where you're least likely to make a profit, and the least obvious ones where you're going to look a fool frequently are the ones where you can profit. So I went on Twitter a little while ago and I said, if a home team is priced at odds of 4, what chance do you think they have of scoring the first goal? Because if you think about it, if they score the first goal, then you can actually trade out for a profit at that particular moment in time. But if you're active and in the market, you sort of need to have some measure as to how frequently that occurs. Now, a team priced at 4 will win a football match 25% of the time. So if you just back them, you're going to pay out 25% of the time. So in order to be profitable when actively trading, you need to balance out your risk and reward, but you also need to be in a position where you sort of exceed that 25% of the time characteristic. So I went out and asked people what their opinion was. You know, if you backed a team at odds of 4, how often do they score first? And you can see the results behind me. Now, the interesting thing was I gave people a list of choices that they could take within this particular question. Everybody guessed, and if you add up the aggregate of these and divide them, and it turns out that everybody on average said that the team would score first 25% of the time, which was great because that's sort of the answer that I was looking for. I hadn't tried to prejudice the outcome. I just asked a basic question. But how often do you think a team scores first if they're priced at odds of 4? Odds of 4 means that they will win the match 25% of the time. So have a look at the list of options that you've got here. How often do you think a team that is priced at odds of 4 will go on to score the first goal? Is it 20%, 30%, 40%? I've given you a list of options here, 15%.
This event is now in play.
I'm waiting for you to have your guess. Please have a guess now. Just say it, speak it to me on the camera. Well, the answer is actually 40% of the time, or just about 40% of the time. So the difference between a bet where you would win 25% of the time and a trade is actually about 15%. Basically, the chance of a team scoring the first goal when they're priced at odds that give them an implied chance of winning 25% of the time actually comes in 15% higher at around 40%. And that is typically your trading opportunity. But again, I must stress, just doing this at random will produce random results and you'll break even. You have to add a little bit more skill into the mix and a little bit of research to be able to turn a strategy like this profitable. But what I wanted to show to you here is that very often what people think and what actually happens can be two very different things, especially when you're talking about an in-play market. So let's summarize things for you here, things that we have learnt during this video. Pre-off markets are completely opinion-based. Basically, people have views, opinions on what the price should or shouldn't be based upon a number of different things, and the market moves within a narrow range that defines, that opinion. Sometimes the range will be smaller or bigger depending upon how well researched the market is, how big the event is, but typically you tend to find that the market is generally opinion-based. If you look at the potential returns that you get from trading these markets, they're equally distributed. Basically, you could win, you could lose, and your skill as a trader is to tip that balance slightly in your favor. But ultimately, your skill is trading based. You have to look at the market, decide what you think it's going to do, take positions based upon that, and that's how you'll ultimately end up profitable in the long term. You don't have to worry too much about what's going on underneath. There are certain situations, for example, team news on football, where you have to keep an eye on things. But because it's an opinion-based market, it purely comes down to your trading skill. Now, when we look at an in-play market, then you'll actually find that in-play markets behave very differently because in-play markets are based upon facts. How much time is left? Is a team a goal up, a goal down? Is the horse in the lead? Has it got the rails? All of these events will alter the price. And you've also got a bit of time decay on certain events as well. Curiously enough, tennis doesn't particularly have a time decay because it's based upon the number of points left to the end of that particular match. But football does, racing does to a certain extent, although it's difficult to spot sometimes. But yeah, in-play odds are set upon facts. So you've got to have an opinion on those facts in order to be able to carve out a niche and edge for yourself. Returns are always unequally distributed. You can get very high win rates on in-play sports, but you can also get absolutely massive losses on those high win rates because that's the market balancing itself out. You can win very frequently, but your potential liability when it comes in could be absolutely massive. That's what we mean by returns are unequally distributed. Unless if you're very, very particular in terms of the strategy that you're trying to attempt to do, then you'll tend to find that the strike rate and the returns are unequal. They're all over the place. It's very important for you to understand that in order to be able to potentially create a profitable strategy. And ultimately, you need to find value in the action. You need to understand what's going on within the market, why that's happening, where you're positioning yourself ahead of that, and also if other people can see that in front of you, because they'll be taking advantage of that as well. But the in-play markets are radically different from the pre-off markets, and therefore you have to treat them very differently. I hope that's something that sort of has come across to you while we've been talking through this presentation. But yeah, two very different modes of operation within the market. So I hope this presentation has been useful for you. I trade pre-off and in-play markets. I can do both, but I meticulously study, analyze everything to death in order to put myself in roughly the right position in what I do. So you may have seen me trade a number of different markets, either tennis, golf, football, in play. But for example, when you look at horse racing, I do in-play stuff, but it tends to be automated. We are going to produce some videos around manual trading and stuff on horse racing, because there are some fundamental things that you need to be aware of. But they're things that we will publish to the Academy so that we can do it in proper depth and in a structured format, because it will take a bit of time to show you each of the examples and why these things occur. But I'm happy to trade both, but the way that I trade each of these markets is radically different. You can't take a pre-off trade and put the same risk management and metrics in play, because it just doesn't work. You have to use entirely different characteristics. You're going to get very different results, very different potential risk, very different profit scenarios, and very different losing scenarios, which you need to balance out carefully between all of them. So yeah, I hope this presentation has been useful for you. Give me a like if you enjoyed it, and I will produce more of these in-depth videos that you may find of interest. And I hope that's given you a lot more information on the difference between pre-off trading and in-play trading on betting exchanges.